Hey, good afternoon, everyone. It's Forex Brizio. It is 3:10 p.m. on Friday, October 20th. I hope everybody's had a great week and had a successful week in the markets, no matter what you traded this week. So I'm back on another video here, and this will be something to talk about for you swing traders out there. And this is in the Forex market. I did backtest this a little bit in some of the futures things that I've shown you guys. I haven't found it to really be very good, quite honestly, but I think in Forex, for swing traders, people that don't have time to be in front of the charts all day and just want to be able to look through their charts, once or twice a day for potential setups, this is a great, simple strategy. Again, no magic here. These are indicators that are available, on any trading platform. I've maybe made a tweak to one of them here based on the pair, but let's go through it. So let's talk about the indicators first. So the moving average is just a 100 period simple moving average. Okay, that's it. So 100 SMA. All right, and this is just to help you establish overall direction and trend and kind of where you should be looking for trades in the long or short direction, or in a sideways market to not trade it at all, because this is designed to be used to get into trending markets, not sideways markets. Moving average strategies are generally horrific strategies to use in a sideways market. So in terms of time frames, the 4 hour or higher is where you want to use this. So again, it's a swing trading strategy. I'm using mainly the 4 hour and the daily, or I may go to the daily just to kind of get overall direction, and then I'm looking for to confirm that on the 4 hour and get my entry on the 4 hour. Okay, and again, this only requires you to look at the charts, maybe a couple of times a day, because again, if you're using a 4 hour chart, you're only getting 6 candles a day, and if you're obviously using a daily chart, you're only getting 1 candle closing a day. So, and let's talk about the other indicator, which is the Williams percent range. So that is an oscillator. So it's available on any trading platform. In MetaTrader, if you go to indicators and oscillators, it's right here. Okay, this was designed by Larry Williams quite a long time ago. Interestingly enough, Williams used it mostly for a day trading strategy, and I'm talking about it on a swing trading strategy. It's a very sensitive indicator, as you can see. I would not use it for day trading, or really, again, anything under a 4 hour, because it gives way too many false signals, even if you extend it. So the default setting on this is 14. So if you go to put the indicator on your chart, it's going to default to 14 periods. Okay? For this strategy, you kind of have to adapt it based on the pairs that you're trading. And I've done some back testing on the 10 or so pairs that I look at, and so my settings on this are anywhere from 5 to 21. I have a couple that are 5, one that's 10, a lot of 14s, and some 21s. Actually, a couple of 14s, mostly 21s, where I've stretched it out a little bit. And it really has to do with how volatile these pairs are. And generally, the higher volume, more volatility they have, the higher the setting you have to put to kind of smooth out the noise. If you have a pair that's generally not traded as much, that tends to be less volatile on a daily basis, you usually have to shorten this. And that's the case here that you're looking at. This is the Kiwi Swiss. I have this set to 5. So the basic thing is, for this, let's just take it as an example. You can see we're on the daily chart. We're in a downtrend. So I'm going to be looking for setups on the 4 hour chart. Now this one, you got some late entries here, but there is an entry right here, and you can see what you're basically looking for is the Williams percent range. If you're looking for a short position, you're looking for the Williams percent range to go up to and at least touch this 30 level. Okay, so you can see on the Williams percent range, you've got a 30 level and a 70 level here. So these are kind of your overbought and oversold ranges. So what you're looking for is the oscillator in a downtrend to come back up and at least get to the 30 line, ideally to come back up into this zone, into the overbought zone. And then as soon as it crosses back through the 30 zone, you get a candle closing in that direction, and you get this crossing back below, which is on this would be right at this candle right here. That's your entry to go short. And as you can see, it gives a really good entry. That's a perfect spot. If you had gone short right here, there's really nothing better. Then you get another entry right here. Okay, and again, perfect entry right here all the way down. Now, you obviously missed all of this because we were going by the moving average. So when price broke, was up here, even though this price action-wise looks like a really good trade, if you're following rules-based, then you wouldn't have taken this. Now, maybe you could have taken it if you're just reading price action, but that gets outside of the rules. You put a trend line here, you wait for it to break because it looks like it's going down. We have a failed new high. Price fails to make a new high. So you can definitely make a case here for price action. But especially for newer traders, if you're just trading strictly a rules-based system and you just, you want to confirm that both things are happening, this is what you do. If we come back over here a little further to the left, again, we'll consider price from here in a downtrend. Okay, and you can see we had a perfect entry right here. Price came back above into the overbought. And then as soon as it crossed down, which was on this candle right here, that would have been our signal to go short, for about 70 pips. And then we had, let's see, we did have a signal here. This one probably would have been a loser. Okay. And then we had this one right here, also would have been a loser. And then the next one would have been an entry for a big winner. I mean, this one here, you could have held it. Even though you got more signals, you got another signal here, you got another signal here. Okay, this one probably would have been a loser, but you had another signal here, another one here. These are all valid signals. So you had a couple of losers, and this is the drawback of any oscillator strategy. And again, I have this set on 5, so it's really extra sensitive. If I lengthened it out here, I probably could have filtered out a couple of these false signals over here, but maybe you missed some of the in-trend signals. So you have to kind of weigh that and just, go back and, play around with the settings and scroll back in your charts and see. And be honest, look at what would have been a valid signal and what would have been a losing signal and adjust it accordingly. So I'm still playing around with these settings, so I may end up reducing this and not having this be 5, but that's the basic strategy. So let's look at a couple of other pairs. So this is the GBP Canadian. Again, if we look kind of like at this area right here, all right, we're in a downtrend. This is that area on the daily chart. All right, you can see that below here, we had a signal right here. This was actually the best signal to take would have been right here. And then there was another one right here. Now you can see, now this is where you're using a little bit longer. This is a 10 period. And on the yellow Kiwi Swiss, you saw how the sensitivity was actually cost us, a couple of losses. Now here, it's the opposite. Having the sensitivity where it is, we're losing out on these intra-trend signals along here, like at this correction. You can see the oscillator never got back above the 30 line to take a signal. And then we had another little pullback here, same thing. Another pullback here, same thing, right? So the trick with this is, get into these when the trend first starts and then just hold it. Because this is, again, the drawback to these oscillators. So if I change that to the 5 period, just for a laugh, you can see it makes the indicator a lot more noisy. But then we do pick up this signal right here, and we do pick up this one right here, and we do pick up this one near the bottom right here, okay? But on the same time, you can see right here, we get another signal to go short. That would have been a loser. This one would have been a loser, right? So you see what I'm saying. There's plus and minuses, advantages and disadvantages over playing around with these with these levels, okay? So in my opinion, it's better off, to avoid losses as much as you can, to have it go a little bit higher. And if you miss a couple of trades, you miss them. But ideally, again, if you catch something like up here, then you just hold it, right? There's no reason to get out of it, any of these trades. There's no reason to get out of these trades, guys, because, clearly it's a very aggressive down move. It's below the moving average. So if you miss them up here, then you miss them. But the problem is if you might catch some of these intra-trend ones here. But the problem is if you just keep blindly taking the signals on the oscillator, then, you had, two losers right here. All right. And you don't want, you want to try to avoid that. Now, I suppose you can say, well, let's look at those two losers. And I'm trying to just be real with you guys. So this one here, you may have thought was going to be a legitimate signal. You get this kind of, larger bearish candle after a couple of small little blue ones. And then it went up. And then when you got this one, it was preceded by, a couple of really big engulfing bullish candles. So maybe that would have been your signal not to take that. Maybe you could say, well, I drew a trend line here and it broke through the trend line, so I'm not looking to, to go short again right there. Okay? So again, guys, you got to play around with these. If you switch it back to the 10 period, okay, we still get this signal right here, right, to go short, and that would have been a loser. But we did not get the other one back here. Okay, this one we never would have gotten, so we would have avoided this loss, but we would have gotten this loss right here, potentially. You went short here, put your stop above, you would have been stopped out. All right? Now, to look at this pair even further, if we go to the daily chart, you can see we're still in a downtrend on the daily. If you go by the moving average, we're still below the 100-period moving average. So theoretically, we could wait for another short signal here. There actually was another signal here to go short, and this actually would have been about an 80 pip win. It wasn't sustained, didn't make a new low, but it did. And then we had another one here. This one was 130 pips before it bounced, and now you can see we're pushing back up above again. So I would use the larger time frame at this point to say, okay, the larger time frame is still down, but we are moving sideways here, so use a little bit of caution. But there potentially is another short coming on this if we get another signal to go down. But again, guys, this is where you have to kind of use some visual price action, not just blindly follow what the indicator is telling you. Use your other visual skills for price action. Again, you could say, well, I'll get a signal here, but I also want a trend line break below here, and that's fine too. Okay? But the bottom line, it's very rules-based in that you use the 100-period moving average to establish the trend on your daily or 4-hour chart. And then you're using the 4-hour chart for your entries based on how you set the Williams percent range indicator. All right? So let's just look at another one. Just randomly, this is dollar Swiss. So if you take from here, you can see we're in an uptrend all the way up to here. Okay, so if we start looking from here, we get a buy signal here. It's kind of weak. Didn't really go very far, but, you had a few pips. You had another one here. Let's see, right there. Again, prices chopped around for a while. We had another one here. All of these would have been potentially small winners or break-even trades, so not awful. Another one here. And then finally we get the one that really starts to break out right here. It pulls back again. And we get another one here. And then we get an intra-trend signal right here. And another one right here. Okay. So this one actually worked out pretty good. It was really choppy for the first several. And again, use your visual skills. You see that price is kind of moving sideways, not really making any progress. Then maybe you wait and just say, well, I'm getting all these positive signals, but maybe I got to wait for price to take out all this area right here, right? I don't want to be stuck in all this choppiness. So maybe I'll wait for price to break out of this range. And that would be probably after this candle right here, right? Or this is actually a really good spot because it actually dips below the moving average and then it goes. So this is actually the prime entry right here. And price goes up and then just keeps going. We grab some liquidity here, run some stop losses below here, and then it goes. So again, guys, no blind following of the signals, but it gives you, a rules-based kind of structured entry. And the biggest thing is, you've got to adjust your the Williams percent range. I don't think there's really a set and forget one length for every pair. Obviously, if you're only trading one or two pairs, it makes your job a lot easier, but you're going to get a lot less signals. So, given that you're using the 4-hour and the daily chart, you're probably only going to get a handful of signals a week, even if you trade multiple pairs. But that's okay. Again, this is meant to be for a swing trader, someone who doesn't want to sit and stare at the charts all the time, and you just kind of want to wait for those trend setups and try to get in at the best possible time. The best value area when price gets overbought on a downtrend or oversold on an uptrend, and that's where the Williams percent range can be really helpful. But again, like I said, guys, there's no magic bullet, and you're going to have false signals, and you're going to have be prepared to perhaps get a couple of losses in a row when price might give you a false signal, but eventually, if that trend is still intact, it will give you a good signal, and you'll more than be able to make up for those losses. So that's what I would encourage you to to be careful. Take your losses, practice good risk management, and then once you do get that winning trade, just hold on to it and ride it as long as you can, and that's really it. So that's the main thing, guys. And like you said, you can go through and look at all the functional pairs that you trade and play around with the setting of the percent range and see what works best. Here's another downtrend. We had a signal to go short here. Okay, you would have gotten 100 or so pips on that one. And again, these are not sustained moves, but remember, this is a longer term time frame. So once you get into these trades, guys, then you can go to a shorter time frame and manage it. And even though this didn't go down very far, it still would have been 100 pips, So it's still a valid signal. You just want to be careful that you don't give it all back. So once I'm in one of these trades, I'd probably manage it on, a shorter time frame, on a 15-minute, 30-minute, 1-hour time frame. We had another signal here. This one was perfect. Another signal here, perfect. Another signal here, perfect. This one here, a small move down, so not great. Maybe you would have got a small profit on this one. Another good signal here, another good one here, another good one here. And then finally we start to recover back where the market's not trending downward as much. So this one probably would have been a loss. All right, and this one, maybe a small profit here. And then we had another winner here. Again, did not make a new low, but still you probably could have picked up 100 pips. And here we are presently. We had this signal here, small profit. All right, and then this one maybe would have been a loser. So the key that you can see here, guys, is you're going to rack up a lot of winners, and you're going to rack up some big winners, but you're also going to rack up a fair number of small losses. So just make sure you practice good risk management. I would definitely use, the swing high, or, in this case, the swing high for a stop loss area. So, if I was trading, like, say, this one, I get a signal here, my stop would have been right above here. Because if this turns out that it's still going up to correct more, I want to be out. As soon as it breaks this high, I'm wrong, and I want to be out. Kind of the same thing here. You get a signal to go short. Let's see where the signal is. Well, actually, this one, you didn't get a signal over here, so this actually was a perfect entry. Let's go over maybe to here. Right, here's one here, right? You get a signal to go short right here. Well, I would have put my stop right above this candle, and you got stopped out right here. All right, that would have been a loser. And then price went down again. You would have, either took this small profit or you would have been stopped out, right here. Okay? So maybe a couple of losers in a row, but then you have this nice winner right here. So, like I said, practice good risk management. Cut your losers short. You definitely use nearby swing highs and lows because, again, you're trading this on a higher time frame. And so, you can be more conservative on your placement of your stop loss. And, like I said, once you're in the trade, manage it on a shorter time frame. However you see fit to manage it on the shorter time frame. All right? So that's it, guys. Any questions or comments, leave them down below. I just thought I'd, offer you up a simple swing trading strategy. As far as the oscillator choice, honestly, you could probably plug in other oscillators here. If you don't like the Williams percent range, you could probably use a stochastic set on like a 1433 setting. You could probably use a MACD, although I find the MACD to be a little bit slow. At the default 12/26/9 settings, I find that to be a little slow. But you could play around with the settings. I'm not a big fan of RSI. I know that's a very popular oscillator, but not a big fan of it. So I would probably stick to either the Williams percent range stochastic or maybe a modified MACD. If you're not, if you're not comfortable with the Williams percent range, you do have some other options, for oscillators, at least kind of standard oscillators. You probably could use the CCI, the Commodity Channel Index. Again, you might have to play around with the settings. I think that one defaults to 14, so you may have to play around with that one too. But that's probably another good one, and I'd probably stick to something in there. So, all right. Anyways, guys, I will leave it there. Questions, comments, please leave them down below. Smash that like button. Really appreciate it. And subscribe to the channel if you're just finding it for the first time. And again, it's Forex Brizio. Look forward to speaking with you again soon, and have a fantastic weekend.